Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Famous and popular SEC attorney in the nation, and we're going to go a bit more detail into some of the investment structures, some of the gotchas and ahas that we want to watch out in syndication, legal paperwork, investment structures, and anything else that's related to the legal document and the way syndications are done. Hey, Gene, why not you tell our audience about yourself and just about your company and what you have been doing and what kind of services do you offer?
Sure. Well, thanks, James. Thanks for having me. I know we've talked several times, but it's fun to be on your podcast here today. Let's talk about my career, which really gets me to where I am today. I came out of college in Midwest Minnesota and went off to sell commercial real estate. So for about 10 years, I was a real estate broker, listing and selling properties in the Twin Cities. And somewhere along the line there, I got my CCIM designation. And that was a 40-year situation where I taught CCIM courses. I still carry my designation, but about 2 years ago, I stopped being on the podium because my other business was so busy and I couldn't take time. So after about 10 years of being a broker and buying some properties myself, I, like almost every other syndicator you'd know, James, found a property that I couldn't buy by myself and I needed other people's money. So I went out and raised money from other people, and lo and behold, here I am, a syndicator. And so I kind of like that. So the next 15, 16 years of my career, I was just a syndicator. I gave up my real estate brokerage business and became a sponsor and primarily built self-storage facilities. We would buy the dirt, we would build the facility, we would sell the facility when it got to be, 50, 60% leased up to an operator of storage facilities, because that wasn't what we wanted to do. We wanted to build, make our profit, and go on to the next project. Well, at one point in time, I had about 850 investors, and I remember I counted them one year. We sent out 1,676 K1s. James, that's a workload. That's a lot of stamps. That's a lot of licking envelopes, a lot of stuff. And in those days, there were no white label back office companies like there are today to help you do that. So it was just my company. And I was faced with a position where I really thought I had to grow my company. I had to get bigger. I had to do other things. And I decided that maybe I didn't want to do that. Maybe I didn't want to be a bigger real estate syndicator than I was. So, James, I went home and sat with my wife around the kitchen table where all the great decisions in life are made, and I said, what am I going to do for the next 15 years? Because I thought I'd retire at about 60 and do something else. And I decided to go to law school. So when I was 45, after having a career as a commercial broker, teaching and being a syndicator, I went off to a law school and became a lawyer, and liked that so much. I've been doing that now for 27 years. I should have retired, 12 years ago, but I didn't. And I like it. And the only law I've ever practiced is law having to do with securities, primarily in the area of Regulation D, Rule 506, which is what we're going to talk about. So here, what I think is important about me and what I try to market about me is I've been all over the commercial real estate brokerage and ownership. I've been all over syndication myself, working with passive investors. I've raised money through the broker-dealer community. I've done all that, and now I bring all that practical experience to my law practice, and seems to make a difference. And like I said, that's all I do. How's that, James?
Yeah, that's awesome. That's awesome. I mean, we have a lot of listeners who are passive investors, but also a lot of active investors listening to this podcast, because we really go into the detail part of the business, right? Especially on multifamily, which is what the asset class that I focuses
Sure.
on, right? So let's go to some of the details on in terms of experience that you have been, right? You have been like almost, you said 27 years doing
Right.
regulation. That's a lot of experience there. What is the most weirdest syndication that you have to do? I mean, not syndication, the most weirdest syndication paperwork that you have to do to buy what?
Oh, well, when a client comes to me, they already have a letter of intent signed on the property, more than likely,
Mhm.
and they're in negotiation for the purchase and sale agreement.
Okay.
The letter of intent and the purchase and sale agreement are generally related to the state in
Okay.
which the property is located. So I can't really get involved in that unless it's in California, where
Mhm.
I'm a California attorney. So I get started.
Hold on, Gene. I think maybe I didn't put my questions correctly. So what was the weirdest syndication that you have to write the paperwork for? Is it like to buy an aeroplane, to buy a ship? Is there any?
No. I'm sorry. So anyhow, people come to me and then I write the syndication paperwork. Probably the most interesting one I've done
interesting one.
was a school. A fellow back east in the Maryland area was teaching, and you might be interested in this approach, James. He was teaching people how to invest. And he came to me and said, I want to do this. And his story was he wanted to do raise money from 35 people, and himself being 36, in a classroom setting, $10,000 from everyone. He'd raise $360,000, and then he would take everyone step by step through the process of hiring an attorney, finding a property, rehabbing the property, selling the property, all the documents, and sharing the profits. And that was his class. You couldn't take the class unless you invested $10,000. And they were all sophisticated investors because they had gone through his training. And that was pretty interesting. I thought that was very clever.
But why you want to do that rather than just paying the $10,000?
Well, he needed $350,000 to buy a property.
Oh, he's buying. Okay, got it.
They bought
so he syndicated within the classroom members.
And everyone was involved in the process, the decisions, and they shared.
Okay, so everybody learned it.
Okay. So I thought that was pretty interesting.
Yeah. You come to my class, but you have to invest in my deal. But I'm going to teach you everything.
He only did that once.
Okay, got it.
But I thought that was interesting.
Yeah, that's really interesting. So one of the things that that I've been going through recently is because I've been doing my own deals on my own. I really usually don't look at other people's deals, but recently I've been past 6-7 months, I look at other people's deals. I was just intrigued by different types of investment structures out there, right? So why not you talk to us about what is the most popular investment structures? Because I think this is where I think the passive investors need to learn and how to structure an investment. Some investment structure are high risk in terms of a passive investor, some are low risk, or is there such thing at all? Why not you tell about your perspective and what are the different types of investment structure that you think exists out there?
Well, okay, the legal structure. Let's take this first. We do an awful lot of business, James, and we use the limited liability company, the LLC, as the legal structure. And the reason for that is it benefits both the passives and the manager. It benefits the manager because the manager has limited liability, as opposed to in a limited partnership where the general partner is totally liable. You really don't want that liability. So it's good for the manager. And then for the investors, it's great for the passives because the passives can vote. In a limited partnerships, the passives can't vote. They have protection, liability protection, but they can't vote. But in an LLC, James, they can not only vote and take part in some of the decisions, but they retain their limited liability. So as far as legal structure goes, that's the most, but far and away the most common structure. Now, as far as it gets down to deals, I'm going to use 3 different definitions. First of all, there's the specific property offering. That's when I come to you, James, and I say, I found this opportunity in a particular property. We're going to buy this property. All the money is going to be spent on this property. Okay. So wouldn't you think that would be something that investors would look at and feel pretty comfortable with that because they know what they're getting? They can see pictures, they can drive by it if it's close. That's probably in the range of what I'm going through, the least risky of the structures. The next structure would be semi-specific. Let's say I've been buying apartment buildings and I'm pretty good at it and I've got a track record and I'm getting a little better at my fundraising. So maybe I find a property I'd like to buy and I get a letter of intent and I put it under contract. And then I go to the attorney and say, you know, it's going to take us $2 million to buy this property on Front Street. But as long as I'm going through all this process, I'd like to raise $5 million and see with the money I raise if I can go out and buy another property. I don't know where it is, I don't know what it is, but I have a business plan that it's going to be, 50 to 100 units, and it's going to be financed like this, and it's going to be a cap rate, and geographically, this is where it is. So you have a property that everyone can look at, and then you have a plan to buy another property. Well, that's a little riskier, right, James? Because we don't have that second property, right? But we do have the first property. And then the most risky is just the blind pool, where if I have a track record, and I wouldn't suggest anyone try this without a track record, and I wouldn't suggest any passive investor invest unless there's a track record of the sponsor. The sponsor can go out and just raise money and say, I have a business plan. I'm going to buy multifamily in a particular geography, a particular size, a particular price range, a particular cap rate, and send me the money, and I'm going to go do that. Well, the positives of that are that's an acquisition strategy approach. Now the syndicators in the marketplace, James, with cash, and can compete with the other cash buyers, 1031 buyers, and can prove up funds. So that's pretty good. But as far as the passives go, we really don't know what we're going to buy. And we've already given our money to the syndicator, and the syndicator is going to go out and buy something. The business plan is kind of like handcuffs on the syndicator. He can't take the money and decide to go out and buy a Walgreens or something. He's going to buy whatever he said he was going to buy. But I think in the area of risk, specific is less risky, semi-specific is a little more, and blind pools are the most risky. And they all today would be in a limited liability company. If you see a limited partnership out there, it's probably because the sponsor thinks they're going to have some Canadian investors, and Canadian investors have to invest in a limited partnership because for Canadian investors, an LLC is double tax like a corporation is. So they don't want that. So that's the answer to that question.
Got it. So that's very interesting because I used to do just direct property by property, and at some point I was looking at semi blind pool and blind pool as well, but I didn't do it because as you said, you need to really know whether you have a property, you have to convince the investors and the strategy and all that. But I really was doing more the deal specific,
Right.
money
Well,
raise, which is
James,
much
one of
easier.
the benefits of a blind pool,
Hmm.
and you have to have this to sell it, is diversification. We're going to put your money and we're going to buy 2 or 3 properties. Okay, so if one's bad, but the other 2 are good. You'd never raise any money, I don't think. I would never advise anyone to try to do a blind pool for one property. Just give me your money and I'll go out and find something. Because I think that's a double sell. First of all, you'd have to sell the investor on giving you the money in the first place. And then when you find the property, I think you stand the risk of the investors saying, oh, no, not that property. And you have to
Right.
give them their money back. So I think that's
Yeah, because you have a pool of property, and you put all your trust in the sponsor, right? So let's talk about some of the way syndication have changed in the past 27 years, right? When you started, I mean, you were a syndicate. I mean, before that, you were a syndicate as well. Can you describe what has changed in terms of the, GP, general partnership, or passive investor? What has changed in the past 27 years? Because I'm sure, I mean, for me, recently, for the past maybe 10 years, syndication become very popular. A lot of people are getting to know about it, but there must be a lot of things must have happened from the last time to the past 10 years, right? Can you tell, based on your experience, what has
okay.
changed?
Well, when I started in 1981, when I started syndicating full time, we used limited partnerships because at that time, the LLC had not been, it had been invented in Wyoming in '79, but it wasn't anywhere else. So we did use limited partnerships. So that was how we started. The limited partners got protection, limited liability, but they couldn't vote. And then the manager could make all this, the general partner, could make all the decisions, but had total liability. So here comes the 1986 and 1987 real estate crash after the tax law change. And all of a sudden, general partners knew what total liability meant. And limited partners said, boy, if I could only have voted, maybe I could have helped save the property. So right after that, the 87, the Tax Act of 86, which caused a huge real estate crash. Right after that, there was a slowdown in syndication because the general partners didn't want to do it anymore. I mean, there was blood on the street, James, from getting destroyed from financing and foreclosures. But all of a sudden, the states caught on to what Wyoming had done. And in the late 80s, various states started passing their own limited liability company law, which was passed to promote capital formation by getting the people that used to be general partners, getting them interested in raising capital again by giving them limited liability. All about that. And getting the passive, the people who were limited partners, getting them interested in investing again, because not only did they have limited liability, which they always had, but now they could vote. So James, there was a big change. And about the same time, Regulation D was modified to introduce something called the Rule 506. And in Rule 506, they said, you can raise as much money as you want from as many accredited investors. Well, they'd never really defined accredited investors until that time. So you can raise as much money as you want from as many accredited investors and 35 people who weren't accredited, but who were smart, but you couldn't advertise. Well, one of the things that was good about that is it let me as a sponsor raise money from 35 sophisticated investors, which I couldn't do before. And it defined what an accredited investor was: $1 million net worth, $200,000 or $300,000 income. We never had that definition. So now we knew exactly what we could do. And so here was Gene as a syndicator. I could go out and raise as much money as I wanted from as many accredited investors and 35 sophisticated investors, but I didn't know where to find the accredited investors. I didn't know where to find the sophisticated investors because I couldn't advertise. And they couldn't find me. Okay, because there was no place, I had no public presence. So the next real change was in 2012 with the Jobs Act. And the Jobs Act came along and said, Gene, what if we let you advertise? What if we let you advertise and go out and find all the accredited investors there are? And why don't we let you advertise in such a way so that all the accredited investors that are out there, and James have like 16 million households with accredited investors, we'll let all of them find you because you can use social media, you can make a website, you can tell everyone what you do. It's just that since you don't know anyone, we're going to have third-party verification that your investors are accredited. You can't take any sophisticated investors, just accredited, raise all the money you want and advertise. So that was the big change. So the change was going from limited partnership to LLC. The change was bringing out 506 and the definition of accredited investors and sophisticated investors. And then the Jobs Act, where now you can go out and advertise and find people that you don't know to invest with you. Those are the three major changes in my career, James.
Got it. Yeah, that's very interesting because you have gone through the entire change process. So it's very interesting to really see how it evolved, right? And what was the reason behind, right? And that was really good learning for me. So, and this is one thing that I want to ask you because I heard you on another webinar where you talked about how does a capital account being treated on a syndication, right? So can you give our audience, some kind of education on how capital account, is being handled differently throughout investment structure on different types of syndication? What is more risky? What is less risky and all that?
Sure. Well, this comes down to two issues. Number one issue is the IRS wants to measure what you have in your investment. And so they give everyone a capital account, okay? And your capital account starts out at zero. Then you make a deposit. Let's say you put $100,000 in an investment. Your capital account has now gone up to $100,000, okay? And let's say you, in the first year, you get a dividend check, you get a distribution check from the investment of $10,000. Well, now you no longer have 100 in the deal, you now have 90 in the deal. And let's say in that year, you also were given a tax loss on your K1 of $10,000. So now you don't have 90 in the deal. Now, according to their bookkeeping, you only have 80 in the deal. And so that capital account goes on during the life of the deal. It can always be increased if you put more money in the deal, and it can always be increased if you have to report income. So there are four things: money in, money out, taxable income reported, taxable losses reported. And when it's all said and done, you're going to have a balance in your capital account the day that the property sells. And the deal there is, if you have a negative in your capital account, let's say you've taken more than 100,000 in cash flow and you've taken losses, your capital account is negative. Well, you started out with a zero capital account and you have to end up with zero. So the cash we give you from the sale is going to increase your capital account back to zero. And how do we increase a capital account? we would increase it by giving you cash, by having you invest cash, which you're not doing. We increase your capital account by having you report taxable income. So that's how at the sale, the taxable income you have to report is calculated by taking whatever your capital account balance is back up to zero. Everyone starts at zero and everyone ends at zero. And it's a mystery to most people, because each year they get, at the end of the year, they get a K1. And when I was syndicating, James, I had all sorts of people call me and say, Gene, I put $100,000 in this deal and I got my first K1 from you, and it says I have $92,000. What happened? Well, then you have to explain to them that the reason it went from 100 to 92, a couple of things might have happened. Did you get some cash flow? Did you get some losses? Did you pay some taxes? Whatever. Okay. It has nothing to do really with the check that you got, because the check is just cash. The capital account is cash and taxable income. So we've got that side of the accounting that the CPA does. Now, the other side is after the property has been operated for a year and there's money in the bank, maybe the sponsor, the syndicator, is going to send some money to the passives, send them a check. Well, that's just like earning interest on your bank account. You put $100,000 in your bank account, you earn 10% interest. You go down to the bank and you pull $10,000, because at the end of the year you have $110,000 in your account. You pull $10,000, which is all your money, interest income, and you still have $100,000 in the investment. Well, right away you can see that that's different than capital accounting. Okay, now we're talking about what was the return on your investment. The return on your investment, if we're using the bank as an example, was 10%. Great. If you pulled $20,000 out of your account, you would have pulled $10,000 of interest, which is a return on your money, and $10,000 of your money. So now the balance in your account is just $90,000. So we're talking apples and oranges here, right? Apples and oranges.
So one is the tax world, one is the investment world, right?
Well, yeah, the capital account is strictly the tax world.
Okay.
And the other account is cash world. Well, here's where it gets interesting. Let's go back to the fact that I put $100,000 in my investment in my LLC, and I own $100,000. And they send me at the end of the year $10,000. And they say, this is the return on your investment from operations of the property. Well, 10,000 compared to my 100,000 looks like 10% cash on cash, right? Okay. So I got a 10% cash on cash. Great. I still have $100,000 in the deal. Next year I get 8,000. Boy, I got an 8% cash on cash. When the deal sells, I get my $100,000 back and share of what's left in the bank. Pretty straightforward, pretty easy to do. That's if, in fact, when you read the document, the sponsor says, we're going to treat cash that comes from the property from operations as a return on your investment. Some sponsors say, no, when we send you a check, we're going to account for it as being a return of your investment. So in my example, I invest 100. They send me a check for 10. And now they say I only have $90,000 left in my investment. Does that make sense, James?
Yeah, that makes sense. But usually
there's a problem there.
Nobody talks about $90,000. Right? They just say here's 10,000, right?
Yeah. No, but the problem is you can't say I'm sending you $10,000 of your money back and tell you got a 10% return on your money.
Correct.
You got $10,000 of your money back.
So is that even a profit, or is that even a?
No, it's not even the way they're counting on it. It's a return of their money, because they're going to keep track until until you get, let's say, 10 years of $10,000. They're going to say you got all your money back. And let's say the property sells at the end of 10 years. And let's say your pro rata share would be 200,000. Okay. If you got all your money back, and the document says, well, we're going to give the investor all their money back, and then we're going to split what's left over 50-50. Well, they've already said you got all your money back. So here's the 200,000 sitting there that they're going to take half of. But if your checks had been the return on your investment each year, you've been getting a 10% interest each year. Now you get to the end, you still have $100,000 in your account. There's 200,000 that's your share. You get 100 to give you your money back. And then we split the 100 50-50. If you follow that, it's kind of hard without doing it on a whiteboard. If you follow that, the bottom line is when you invest in a deal and the sponsor says everything we give you is going to be a return of your money, number one, the sponsor cannot call that cash on cash because that's fraudulent. Okay. He can say we're going to give you a distribution of 10%. That's not fraudulent, but it's not cash on cash. It's just a distribution of your original investment. And number two,
can they say it's a cash flow of 10%?
Well, yeah, but you can't put a percentage out. Well, it's a distribution of 10% based on your original investment. Okay. It's not earning. It's not a return on.
So they can't say it's a 10%. They can just say, I'm giving you 10,000.
I'm giving you 10,000, which is a 10% distribution on your original investment. There's nothing wrong with saying that, but it's not earnings.
It's not earnings. Okay.
And then the last thing is when you get to the sale, the 50-50 split benefits the sponsor because you get to the 50-50 split faster if all the cash flow during operations is just considered a return of their investment.
Yeah. The pie to cut at the back is much larger.
Much larger for the sponsor. No, that rule benefits the sponsor. Now, I'm not saying that's good or bad. It just benefits the sponsor. My most prolific syndicator, James, you'll love this, is since 2014, when I started working with him, has done 116 offerings with me, James, raising between 5 and 10 million at a time. And his cash distribution pattern is 12%. 8 is a return on, and 4 is a return of. So we say that the distribution is 12 based on your original investment, but then we break it down and tell you what did you earn and what's an early return of your principal. So you could do it that way.
Yeah, that's a good, I think as long as you're getting profit, like a reasonable 8% profit on your money, and the remaining you can put under capital, I think that's a fair game, right? So, but don't you think that when people giving, like say for example, you're getting just 8% cash on cash, cash distribute. I don't know. It's very tricky to make sure that we don't say cash on cash, right? Because it's not really cash on cash.
That would be fraudulent. That would be fraud.
Correct. So when they said I'm giving you 8% distribution, and let's say for next 5 years you're giving 8%, the thing is you're not really making money, right? So that means your money is actually you're losing money because
in that accounting, in that accounting, everything is a return of, and in your example, we're now down to only having 60,000 in the fund. In the cash distribution accounting, property sells, there's $200,000 available for your share. You get 60 to return the balance, and then there's 140 left that'll be split 50-50.
Yeah. So what's the risk to passive investor when they do that?
Well, the risk is not understanding. I'm thinking that maybe the risk is going out and spending all that money when you think you're earning it.
But don't you think that if I put 100,000, I didn't make money for next 5 years because I'm just getting back my own capital, right?
Well, in the end, when you go to calculate it, yes, that's right.
Yeah, you're just getting back your own money.
Mhm.
And it's a promise to make money at the sale, because the only time you make money is at the sale.
Well, right. Well, let's look at it this way. Let's say that we invest 100,000,
Mhm.
and the first 5 years, there's $20,000 distributed to us each year. Okay. But then we continue to go on and run the property. Well, from then on, everything that comes to us is earnings.
Mhm. But that's
because we
after
got all
5
the
years.
money back. Right. So we got all of our money back. So, and that is what's on the sale tax wise. What's on the sale is all the return of your capital on the sale is just a return of capital. Anything more than that is another return on capital. So
Correct.
we have two worlds. We have capital accounting and we have cash. And
Yeah.
some of the sponsors who do return of say, well, that's what the accountant does. The accountant does that in the K1. Well, I've already said that the K1 has 4 things going on, not just cash in and cash out. It has taxable income and taxable losses. So it isn't just crystal clear that the K1 represents cash. It represents 2 other things. So you can't compare them.
So in the tax world, what you're saying is whether you do return off capital, return on capital, it's the same in the tax world. Is that right?
Oh, it doesn't make any difference. Yeah.
Okay.
No,
Okay.
they're right. The sponsors who say when we send you your check back, it reduces your capital account. That's absolutely correct.
Got
But
it. But that's the same
there's
even
more
on
to
when
it.
you do return on capital, right? So,
Mhm.
yeah, it's just different way of doing it. So one is what you said is passive risk is the not understanding, right? But what?
Yes, that's right. Not understanding. And I know my documents say specifically at the end of the description of cash distribution on operations and cash distribution on capital account. We have a little paragraph in there that says specifically if we're doing return on or return of. And when I do return of for clients, and we make a descriptive paragraph so that no one is surprised. I think that one of the issues, have you read my book?
I do have your book. I think I read a
Okay.
few chapters of it. Yes.
Yeah, I've got a chapter on.
That was like 5 years ago
accounting.
when the
Yeah,
book
well,
first came out. I'm sure there's a lot of ref that came out after that, right?
I've got a chapter in there on accounting, and it goes through a sample project showing you the individual's capital account, the company's capital account, the basis, and all that in an example. And I question whether every sponsor understands that. I actually will tell you that I did a presentation for a CPA group a couple of weeks ago, and in my Zoom broadcast, I had to have 4 questions, a polling question. And one of the questions I asked was, when your clients come to you and talk to you about the distribution pattern in their PPM and their operating agreement, do they come to you before they write it and get their investors, or do they come to you afterwards? And the huge majority of the accountants said, well, they come after they've already raised money. So we've got clients out there who haven't really asked their CPA if this is the right way to do it. That's frightening.
Got it. So why do a passive want to invest in that kind of structure where there's a return of capital? Let's say I'm a passive and I understand this is return of capital. Why do you think it's beneficial for that kind of structure compared to return on capital?
I think at the disposition of the asset, at the capital event, refinance or sale, it's more beneficial to the sponsor if everything has been treated as a return of capital. That's what I think.
Okay.
Less beneficial to the investor.
Yeah, because I think sometimes I hear people do the sale saying that I'm reducing your risk because I'm giving back all your capital upfront.
Well, that isn't the case. So they really aren't giving you your capital, they're giving you cash. You get the same amount of cash either way. The question is, how are we going to calculate the ending split? That's the issue.
Yeah, and the ending split is usually projected to be, you're making money on the sales, right? So
right.
But sometimes you may never make money, right? I mean, Yeah, right. So if you're not making money during the operations, basically you're not making money during operation. And at the sales, you're basically making a promise that you may make money because sales happen 5 years down the road. No one
Right.
knows what's going to happen on the economy, right? So
And almost everyone writes their offerings that at the sale, the investors get the return of their capital, of their unreturned capital, and any check if there's been a preferred return that hasn't been paid, and then there's the split. So that's always the pattern.
yeah,
I shouldn't say always, 90% that's a pattern. Sometimes the pattern is just on the split, on the sale, we do 80-20. I have a lot of experienced syndicators, James, who don't do preferred returns. They just do 80-20 splits on everything, period.
yeah, that's another thing because yeah, what you mentioned just now is when on the sale, they're supposed to give back to make the investor whole again, right? But some syndication doesn't do that. They just split everything, right? So that's basically if you buy in day one and sell in day two, you lost 20% of your money if it's 80-20 split.
Right.
Right. So okay. I think it's just different structures and how people want to do it, and whether investors are comfortable with that or not, right?
So it makes a difference whether you read your documents and understand them. So when you go out and talk to passives about what they should do, which I know you do, you should dwell on the fact that they should read the document. Now, if they're investing for the 5th time with the same sponsor, chances are the documents are the same, but you never know. You never know. So you've got to read the document.
Where do passive investors go to understand the structure? Because
they go to your school. They
okay.
take classes. They find mentors like you.
Okay.
I don't mentor passives.
Okay.
I mentor syndicators.
Okay.
And there's conflict there. So I just, my world is syndicators, and I do a lot of education-based marketing, James.
Got it.
Training syndication. I have classes for rookies, and a rookie may have a lot of real estate experience, but they've never done syndication. So I only let rookies in the class, and that's a pretty eye-opening event. So
got it. One other question I have for you is I've seen syndicators nowadays creating a separate account compared to the NOI of that asset to do distribution for the investors. Right, like for example, they overraise the money, right, into a separate account while they stabilize the property, while they stabilize.
And they send the investors their money back.
Correct. Yeah,
okay.
they do these. So what do you think about that?
Depending upon, I have a couple thoughts. Depending upon how they word that, that's fraud. If they say we're going to give you a 6% preferred return, and they raise 12% extra, and put it in the bank and say, that's the money I'm going to send you back. A preferred return is a return on its earnings. All you're doing is sending people some of their money back. And if you don't tell them you're just sending their money back to them, that's fraud. And I wonder why an investor would want to give you that extra 12% to put in the bank just so they can give you a check so you can buy groceries. Why don't they keep that 12% themselves? See, I think that's fraud. And I don't think it's a great sales technique to tell people we're raising a lot of money and then we're going to send you your money back. Just tell them we won't be able to make any distributions for a year. Almost every offering I write has a 6, 9, or 12-month delay in the distribution. Do you think someone who puts $50,000 in your deal needs a $12 check every month to buy groceries?
Well, a lot of syndicators are doing it. I mean, I'll be very
well. I think that's wrong. I think it's unless you tell them.
Yeah. Okay. Well, they claim everybody knows, but I can bet you
no
one knows.
They don't claim everyone knows. They don't claim everyone knows.
And I always wonder how are you giving day one money, and I can tell you why they're doing it, because they want to juice up the investors so they can keep on investing, because these people do deals every month. So when investors see that, I'm getting like 8 to 10% return on day one, when's your next deal? That's the next question they invest. So they keep on.
Yes, if I sent you if I sent you your money back. But that's kind of interesting. If you're paying a preferred return, you're paying a preferred return on that extra money you raised just to give the people their own money back. So that's a burden for the sponsor. Now, all I'm going to say is that isn't explained correctly, and that should be in the sources and uses table of what you're doing. That should be identified as a line item. If you don't do that right, you run the risk of being accused of fraud.
Yeah, I think it's all inside the CapEx budget. It's not a separate line item. Nobody puts a line item
that's not CapEx.
Well,
that's
that's
not
true.
CapEx.
Nobody puts money to pay investors line item.
Well, then they're I've said enough. This is I'm in good spirit today. Because as we're talking, we're getting close to the Christmas holidays, and I'm in good spirit. But I'm telling you, that is fraud.
Yeah. Well, I mean, for me, I always say wait until I stabilize the deal, and all my investors are happy to wait because they know we want to get money from the investors, right? But there are quite a number of syndicators out there. They say, oh, close today. Next month you start getting checks, and this is a value add deal. And when I calculate their mortgage and payment, you can never get that 8%, right? So, and they, I mean, this is the post that I did in my LinkedIn, and everybody consensus was, yeah, of course they're over raising and paying back. They said just make the investors happy. So why you want to do that, right? I mean, you are not doing the right thing, right? But I didn't know that preferred return is supposed to be a return on investment.
On earnings, right?
Okay.
A 6%. Anytime you put a percentage number after it, it's supposed to be a measure of return on your investment. And so, so I'm going to give you a 6% return on your investment, but I'm going to send you your money back, because that's always the magic. Can you tell the difference in the offering between the return of someone's money and the return on someone's money? That's very important.
Yeah, and sometimes
let's get off of that topic. Let's get off of that topic, and let's not go to the topic where people are asking other people to raise money for them. I don't want to go to that topic either. Okay.
Oh, sure. Well, I want to go with that too. the equity raises, but that's okay. We'll cover it in a different.
Ask me back. Can I give you 4 questions that I think the passive investors should ask?
Sure, absolutely. Do that.
Okay. Question number 1, James, I like your deal. It's got a $50,000 minimum. I can invest the $50,000, but my question to you, James, is what happens if something happens to you?
Who's the backup, right, that we have, right?
Yeah. Where's the continuity? Who's the backup? I will not write an offering for James. If James comes to me and he says, no, I'm going to be the individual manager. I'm going to be an LLC. I'm going to be the individual member, the sole member, and that's all I'm going to be. Well, you go somewhere else, because that's not safe for the investors. Not at all. Plus, but the bank's not going to go along with that.
Yeah, we always have backup.
Springing members and all, you've got to have continuity. So as I said, I don't really counsel passives, but if a passive called me and said, will you look at these documents? I would say, well, here's the 4 questions I would ask of these documents. First question is, if it's an individual manager, don't invest. Number 2, James, have you done this before? Okay, all of us have had to answer that question. No, I've never put together a syndication. I've never put together an offering. I have my own real estate investment history and my own education, all that. But no, I haven't done an offering. Well, tell them the truth. And then one of my big important things is you got to get that first deal done and make it a success. Don't try to raise 30 million on your first deal. Do a little deal. So when I ask James, have you done this before? James can say, hell yes, Gene, once. Good enough. Good enough. Track record. Good enough. You got to get started somewhere. Third question, James, are you going to invest any money? Are you going to have a skin in the game? Okay. Skin in the game is one of 2 things. It's James cash, going to buy some units just like I am, and the fact that James has to sign on the mortgage. I don't care if it's a non-recourse mortgage. James is signing on the mortgage. Both of those things show me that James has skin in the game, right? And number 4, James, I'm 72 years old. You say that your holding period on this project is somewhere between 7 and 10 years. What's going to happen if my family needs my money out of this deal? How do I get my money? And your answer is, well, we have a well-drafted operating agreement. And in Articles 12 and 13, we talk about liquidity, whether it's voluntary or it's forced. And we can go over that together, and you'll see that we've made arrangements for that for you. Okay. Those are the 4 questions. James, I never asked, what's the yield? I never asked, what's the NOI? I never asked, what's the price per door? I never asked any of that stuff. I want to know if there's continuity, so my money's safe. I want to know if you've done this before, so my money's safe. I want to know if you have money in the deal or your name on the line, so my money's safe. And then I want to know if there's a liquidity provision, so if I need it, my money's safe. That's what I would ask.
That's very interesting. Thank you for that. That's really a good direct points to any passive investors, right? Gene, we are at the end of.
James, if you're if you're the sponsor, you better have answers to all those questions.
Oh, right? Yeah, absolutely.
There you go.
And we want to make sure we take care of our investors all the time, right? Because anything can happen, and anything can happen to anyone, right? So we want to just make sure that we take care of everyone. So Gene, why not you tell our audience how to get hold of you and how to get in touch, contact with you.
James, I've been telling them the whole time. Okay.
Yeah, that's a good bot behind, right? That's in YouTube, but we have to tell it to the podcast listeners who's listening.
Oh, if it's a verbal one. Okay. So yeah. My website is Trowbridge Law Group, and Trowbridge is TROW Bridge, TrowbridgeLawGroup.com. And my email is gene@trowbridgelawgroup.com. And I'll just give you my direct phone number, 949, I'm out in California, 949-855-8399. Free consultations, call me with your questions. Love to talk to you, love to get to know you. And one of the things we do that I'm proud about, we have something called TLG Talks. TLG stands for Trowbridge Law Group. But TLG Talks, we have a YouTube channel. It's YouTube at Trowbridge Law. And right now we're running a series of interviews where I've interviewed 16 people that are part of this industry. And they're about half-hour interviews, and we're playing them on YouTube. And they broadcast live every Thursday at 12 o'clock Pacific time for a half an hour. And we've had some really interesting, we've had 14 syndicators, one person who would never do a syndication who's extremely successful, and that was an interesting interview, and another person who's a rookie who's come to us from my rookie class and is getting started, and that itself was an interesting interview. So YouTube, Trowbridge Law, and you can look at all sorts of stuff we have there. So that's it, James.
Awesome.
Thanks for having me.
Thanks for coming. Thank you. That's it. Bye.
Bye.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.